The attendees are going to recording the progress, and the attendees are in listen mode. Are going to be in listen mode only. Use your Q&A box to submit questions, and we'll do our best to get to some of those questions and to have kind of a conversation about what's going on today. I appreciate all the questions that were submitted in advance, so we were able to ask. We'll be able to ask a lot of those, maybe not everything. And this webinar is going to be recorded, and later on you can go ahead and see it on the CCIM YouTube channel. Okay. So our agenda today is going to be, we're going to welcome and recognize our sponsors. We're going to go ahead and do an audience poll to see who's here today. What's your niche, who you are, okay, just to have a better idea of who our audience is. At 11:30, the program will start. I'll do an introduction of all the panelists. We'll do that from 11:30 to 12:30. And at 12:30, the webinar is going to conclude, but at 12:45, we're going to do a raffle prize drawing. And so you need to be present to win. So you're going to have to go through this whole thing to get your raffle drawing. So that's what we got. So anyways, let's see here. So I just want to just appreciate the friends of CCIM because of all the support while we're able to do these events. And our platinum sponsors are Heck Solberg, Marcus and Millichap, PMB Healthcare Real Estate, and Seville's. Also, our gold sponsors are CoStar, Exeter 1031 Exchange Services, Mission Federal Credit Union, SCS Engineering, and Slack Capital. It's because of their support and other support, through IREM that we're able to do events like this, workshops, and webinars. So, Kim, what are you have some stuff that you got to go over here?
Yes, thank you, Curtis. We're happy to be here today in this joint meeting with CCIM and IREM. IREM is an international institute for property and asset managers, providing complete knowledge to take on real estate management's most dynamic challenges. That means knowledge prepared for the day-to-day and the one-of-a-kind, from solving the latest tenant crisis to analyzing market conditions. For over 85 years, our members have made us the world's strongest voice for all things real estate management. Today, almost 20,000 leaders in commercial and residential management call this home for learning, certifications, and networking. The San Diego chapter of IREM celebrates its 74th year anniversary this year. The chapter is very strong with over 400 members. Please see our flyers on our website at iremsd.org for any of our upcoming events. We couldn't be here today, just like CCIM, without our wonderful industry partners, and I would like to recognize those today. Our Platinum IIPs, Brightview Landscape Services, CAM Property Services, Blue Sky Restoration Contractors, and also our Gold IIPs, AMS Paving, Apartments.com CoStar, Countywide Mechanical Systems, Keith Monroe Painting, Paragon Services, Sherwin-Williams, Sully Jones Roofing Company, and the Forestry Group. Let's thank them all.
All right. Okay.
So there are 155 of us here today, and we'd like to do a poll to see where our backgrounds are in real estate management. So Ellen is going to launch that poll, so please chime in.
All right. Perfect. So
all right, they're all coming in. Let's get a couple of more here.
All right. I think I skipped a couple things, Kim. So while we're getting the poll, I just wanted to, it's okay to introduce a little bit of CCIM. First off, I really just appreciate everyone being here, and I appreciate IREM for having this joint conference with us. But CCIM stands for Certified Commercial Investment Member. It's a very prestigious designation. It's through a lot of hard work, a lot of coursework, and it really helps work a lot of complicated transactions and be able to understand things like internal rate of returns, leases, mortgage balances of real estate, really help in complex transactions. I've I've earned my CCIM. It took me quite a while to get through it, but it's been so helpful in everything that I've done. Also, I wanted just the CCIM San Diego chapter. We're really your local chapter for CCIM. We're just an advocate for commercial real estate here. And what we try to do is just, we want to work with managers, property managers, brokers, lenders, and other commercial real estate professionals. Just to be able to not just network, but to bring everyone together to help educate and to bring on programs and basically try to increase our level of confidence in this industry. Information, upcoming events for CCIM could be ccimsandiego.com. I also want to introduce our chapter past president in attendance today, Tom Aycock, who's a chapter president in 1994. So he's been around for a little while in the business. So he probably has something he can teach us. But I appreciate you being a past president with us. So that was kind of wanted to go through there as we're going through this poll. Did you have anything else to say, Kim?
Yeah, so all the results are in, and we've got a great mix here today. We have about 31% of us are owner investors, about 4% lenders, 20% are brokers, 20% property managers, and another 24% identify as others. So I think this is going to be a great panel here to kind of give us information to hit all these niches. And I'm going to turn it back over to you, Curtis.
Okay. Thank you. We appreciate that. And I think what I mentioned before is we're going to record all of this. And when we're done, we're going to also probably include some polls once we're done, and we can share that information with everyone. So what we'll do is we have some ideas of polls that we're going to do, but if people have ideas of information they want to get from other people on here, for example, are people buyers or sellers right now in this market? So just questions that you're curious about other people in the industry, what they're going to want. I think we can put some polls out when we're done with this event to try to get people to fill it out. And I'm kind of curious to what people are going to say about that. Should we start a little early, Kim, or should we just small talk here?
I think we can go ahead and get into it. I think there's a lot to cover across all the industries. So I think we should start right at it.
Okay. All right. Let's go ahead, and what we're going to do is we're going to have each speaker, they're going to talk for a few minutes just kind of about what they do, kind of overall market. Once everyone goes through that, we're going to have Josh Ohl, then we're going to have Lisa Strom, we're going to have Andy Huggitt, and then we're going to have Robert Valera talk, right? So once they go through their, just kind of talk about the market briefly, then we're going to start going into some Q&A and kind of just, our goal here is to kind of have a dialogue and just kind of have a free-flowing conversation and try to answer questions that are important to everyone and see kind of where it goes from there. I really appreciate Josh coming on here today. He's a wealth of knowledge. Josh is from CoStar. He's the director of marketing analytics for CoStar Group. His focus is on market analytics in the San Diego market. He's frequently authored in a lot of different trade journals and publications. He's authored over 100 reports. And he's going to be able to answer a lot of questions. So we thought he would go first because he's going to probably just give a broad overview of the different markets and what he's seeing out there. Once he goes through that, we'll have Lisa go ahead and I'll introduce her at that time. Go ahead, Josh.
All right. Thanks a lot, Curtis. Thanks, everybody. Happy to be here today. I'm going to give sort of a quick 30,000-foot view, at least, of what I'm seeing in San Diego. I spend my days just looking at data and talking to people. And I think we'll start with sort of all starts with the local economy, right? And we sort of have some up and down signals in the local economy. We had 2,000 jobs that were added last month. It's probably less than expected. Year over year, we look good. We had about 9.5% employment growth, or about 119,000 jobs. So that's good. If you benchmark it to February of 2020, we're still down about 7.5% employment levels. And that's about 114,000 jobs. So we still have a ways to go before we get back all the jobs that we lost. And that's sort of one of the things that I think a lot of businesses are certainly encountering right now, is finding employees to fill out, especially as they're reopening, as the COVID related restrictions have fallen off. But of course, and I know Andrew will get into this, We are lucky to be one of the foundational life science markets in the world right here, and that's always going to be a strength of our local economy, not to mention our military infrastructure, our increasing tech presence here. So those things are just foundational to our market. So those are very supportive of our local economy. And we look at our commercial sectors, there's a lot of interesting signals. We look at I'll kind of hit on one or 2 points on each property type. We look at industrial, there's been no retrenchment. Industrial is on fire. We are reaching like record levels of leasing volume, and it's not just all Amazon, even though they're the ones in the headlines. We're getting expansions into lab and flex space from life science firms, and we just have logistics firms that are expanding all over the market. Year over year, the availability rates are down in pretty much every sector, and we have reached only about 6% of total inventory that's available for lease. We go to the multifamily side. Demand is insanely high on the multifamily sector right now. I think you talk to PMs across the market. I think a lot of PMs are going to tell you they just haven't really seen this much demand before, where there are a lot of communities are just 100% occupied right now. Of course, an eviction moratorium has a part to play in that, keeping communities filled, but we also are on the back of that demand, have seen rent growth at levels we just haven't seen either. We're at, across the region, we're at 9.5% rent growth. The second quarter, we had 4.6% rent growth, which is about 2.5 times the level of generally the average second quarters, which is usually our best quarter for rent growth. So everything is on fire right now. The office sector it looks like it might have turned the corner a little bit. It looks like sublet space has peaked at the end of 2020, and it's coming down. So that's a good sign. I know Lisa's going to get into a number of the office fundamentals too, but we just had our best quarter for leasing since the beginning of the pandemic. So that's another good sign for the office market. The retail market, similarly, leasing volume has reached its highest level amid the pandemic. We sort of have this sort of secular change in the retail industry that began prior to the pandemic that looks like it's continuing now, especially with experiential tenants are doing really well and taking up a lot of spaces. Rent growth looks like it's on the mend a little bit. We're back in a little bit of positive territory there. So it looks like most of the sectors have turned the corner here. And that's all for me. I'll turn it over now. Thank you.
Thanks a lot, Josh. I know we're going to end up getting into a lot more of those, expanding a lot of those statements that you made in questions once we get done with the panelists here. I just want to introduce Lisa Strom. Her focus is on commercial real estate. She is executive vice president and principal for Strom Commercial. She's been in the business for over 20 years, specialized in representing institutional owners and investors in the region's largest office submarkets. She previously worked for the Irvine company as a senior leasing director and a director of leasing for equity office properties. So she has a lot of experience here, and she's going to really be a wealth of knowledge. Lisa, why don't you go ahead and kind of go into what you think is important right now?
Thanks, Curtis, and thanks everybody for taking the time out of your busy schedules to participate in this market update with CCIM and IREM. So my background has primarily been in institutional high-rise and Class A landlord leasing, but over the last year and a half, since I left the Irvine company, I've actually been doing a lot of tenant representation work as well. So I'm in a unique position to see kind of both sides of the marketplace at this point in time. Just on a macro level, dovetailing on what Josh was discussing earlier, the region right now is at about 14% direct vacancy over our total office portfolio. And then that can be broken out. Downtown's kind of the biggest sufferer right now at 24%. And then our suburban markets that are about 12%. And then depending on, whose data set you focus on, net absorption has gone from either slight negative to very slight positive. But I think that dovetails into, we're seeing a turnaround in the office market, definitely. We're seeing increase in activity, and we're seeing some historic high rents, not just asking rents, but strike price rents, as well as some large sales activity. So most notably, just a couple of months ago, Emmis basically sold their downtown portfolio of 1.5 million square feet to an LA-based owner, Regent Properties. And that sales price was about $275 a square foot over 4 buildings in a parking structure. Kilroy just bought a 0.6 acre site on Pacific Coast Highway, and they paid about $58 million for that site. And it's, if any of you are familiar with it, it's the mobile gas station site downtown. So they've got plans to develop that. And, you know, Del Mar Heights on fire right now, UTC on fire. Both those markets are looking at sub 10% vacancy rates and historic high, you know, asking rates. So we're feeling that our office tenants are coming back to work. And what we're seeing primarily is the professional services groups are leading the way, trailed by tech. So more to come on that, but that's just some of the high notes right now in the office market in San Diego.
Okay, thanks, Lisa. We'll definitely go into that more. Our next presenter is going to be Andy Huggitt. Andy specializes in life science and biotech. He's been with CBRE since 2015, but has been in the business for almost 20 years now. His area of expertise includes corporate real estate portfolios. He's also has let me just look here there. He has some pretty big name clients here. He's worked with everyone from like Abbott, Vertex Pharmaceuticals, and Exact Sciences, to name a few. So Andy does a lot of institutional work, a lot of life science, a lot of biotech. So I think a lot of people are interested in kind of what's going on, because it definitely seems like that industry is one of the big industries that's really pushing San Diego in values in so many different sectors. So Andy, why don't you kind of go into that a little bit, what you're seeing out there?
Yeah, thanks, Curtis, and thanks for having me today. It's I did this last year during the height of COVID, so it's a little bit different this year, for sure, and more enjoyable. I think in San Diego, the life science sector has been something that I think really, you know, was on the positive and lucky side of COVID. You know, we've had just in the past year record high venture capital inflow, which really drives our market. It used to be a 6 to 12 month laggard behind that for the real estate event, whether it's venture capital or some sort of IPO funding event. Now we're seeing groups that are, you know, 2 months before that event and hitting the market in anticipation of it. So, and not only going from, you know, 5 to 20,000 square feet, it's going from like 15, 20,000 square feet to 60 to 100, and doing kind of like the San Francisco tech move of, you know, we'll take the 100, but we'll also take the additional 40 on top of that because we think we're going to need it in 3 years, and we'll figure out how to occupy it. So, you know, record high demand, record low vacancy and availability. Torrey Pines right now, we're getting our preliminary second quarter stats, sub 1% availability. You're going to have sub 1% in UTC, and there's a number of transactions that are probably going to happen over the next quarter to 2 quarters that will take up that remaining small pieces that are left. So a lot of conversion activity going on, which it's interesting to hear, you know, from Lisa on the office side. You know, I was always curious to see what was going to happen as the more of the conversions keep going on, the office space goes away. I have a perfect example of that where I can't find space for office in Eastern Sorrento because you have groups, you know, acquiring projects that are just being converted. So every owner is kind of holding off on what they're going to do and releasing space because they might be able to sell it, you know, to an Alexandria or Longfellow or one of the groups that's going to come in and pay a huge number for it. So a lot of that is going on, different dynamics. COVID, you know, definitely I think for the first 30 days of it, like that March period, everyone was kind of holding their breath to see what happened. And then come April, May, it just took off. Our demand went from like 1.2 million square feet to at some points 2.5 million. Now it's up to, you know, 3 to 3.5 million square feet of demand, which is approaching San Francisco and Boston type of demand. Problem is you have maybe 900 square feet of supply, right? So there's definitely a you know, a line at the counter for space. You know, if you're out in the market, you're competing with 2 to 3 groups for every piece of space you're looking at. Space that's built spec usually gets leased before it even comes online as spec, which starts to push everything into the questions of, you know, where are the next markets? Obviously, Del Mar Heights had a recent transaction with Kilroy. It's going to be conversion going on there. There's a couple other projects in the queue that are likely going to happen there in the next month. to 2 months, and 56 corridor. And then you look at, out to the I-15 market, there's going to be a lot more conversion for manufacturing out there. And then down into downtown, where I'm hearing there's proposals out on a couple projects there for users. So interesting times in the life science side. Everyone's wondering how far it's going to run and how high it's going to get. But, right now we're definitely enjoying that space. So.
Great. Wow. Who'd have think, a year ago that, everything would be going so gangbusters. So I guess anyways, next speaker is Robert Valera. He's a partner of Voigt Real Estate. He specializes in the brokerage of apartments and multifamily development sites within San Diego County. He's closed over 350 transactions, multifamily properties. He's also an investor himself. I've known Robert for a long time. He's one of the people I call, I'm more into the multifamily myself. Robert's been someone that I've looked up to for a long time, has a wealth of information. So I appreciate you being on this event, Robert.
Well, thanks. I've got to say, I wrote a little note. I said, it's starting to look like a back to the 70s. And then I crossed out the word look and I wrote feel. Helen, can you pop up that first slide that we've got? Yeah, this captures the spirit of 2021. We've got a big pile of blow that's been dumped on the table. You can say maybe Uncle Sam's the dealer, or maybe it's Uncle Joe there in the corner. That blow, that's the stimulus. Nobody gets to leave the party until that's gone. Put on your seatbelts for the multifamily sector. Anyone active, whether it's in the for rent side or the for sale side, knows that this market's really going off right now. On the rental market, during the pandemic, major owners and property managers that I was speaking with mentioned that they were seeing their delinquency rate go up by about 2% here in San Diego County. Now, we got lucky. Up in the Los Angeles area, we were hearing figures closer to 10%. Up in the Bay Area, closer to 12%. These are delinquencies, non-pays because of COVID issues, or tenants taking advantage of the regulatory breaks that were being given to tenants. In San Diego, as I said, we're fortunate we did not have as many problems. Now, as units are coming open, what I'm hearing from property managers is their gut sense is we've seen about a 10, market rents are up about 10% above pre-pandemic levels.
Wow.
Shifting over to the sales side, I'm looking at median price per square foot. The cap rates that are being reported are not terribly accurate. If you're looking at any apartments for purchase, you realize, okay, what income stream am I applying the cap rate to? Am I applying it to the existing income stream? Am I applying it to full market rents based on the property and its current condition? Or am I looking at a post-renovation income stream? So I think we get more stable and valid statistics looking at price per square foot. In the first half of 2021, we're looking at a median sales price per square foot for San Diego County apartments at $382.
Wow.
2019 was $349 a square foot. So that's a 9% increase over where the market was prior to entering the pandemic. Who's buying and who's selling? We are seeing some owners taking capital out of California. I think one of the things we are hearing from most typically from sellers is there's a concern about the overall regulatory environment. So it's not just rent control, but in addition to the statewide rent control and always the possibility that we could end up with a more restrictive local rent control, there's just concerns about the erosion of property rights. As we saw, during the pandemic, where if the tenant couldn't pay rent, they were going to be left in place. A lot of owners were going to do that anyway, but of course the state and local governments came down with mandates. So even if you're in a position where you might potentially lose your property to foreclosure because of non-payment, you still couldn't remove tenants. I'm seeing some, I'm going to call it generational turnover. We have members of the silent generation and some of the older baby boomers who have hit the point where they feel like they're done with apartments. They're looking at current tax rates and they're saying, I don't want to pay all of that in taxes, but maybe it's better to do it this year than to wait till next year. So we have sellers out there, we have motivations for people to sell, and we've got buyers, which is what it takes to make an active market, buyers and sellers. For the buyers, it's really being driven by low yield on alternative investments. Traditionally, retirees would have a large chunk of their portfolio in bonds to generate steady income. At today's interest rates, that doesn't look attractive at all. And there's a lot of risk in investing in bonds. If interest rates should reverse and rise, those bonds are going to take a major capital hit. And so there's money, both private parties and institutions looking to move money into income producing property. And with the tight rental market, residential is a favored place to go. We're also seeing, I'm going to say, a more sophisticated young investor, cadre of young investors here in San Diego County who are out raising funds and raising private equity and putting together investment groups. And I really think the real estate programs at our universities here, San Diego State, USD, and now UCSD, are players in this. We've had a couple of decades now where we've had students coming out of these programs coming into real estate with a more sophisticated skill set than what we would have seen 30, 40 years ago. And I think a lot of them are learning how to operate at scale much more quickly than what we've seen in the past. And when you have aggressive young players out there in the market that aren't just acquiring one or two properties, but have goals of acquiring properties by the dozens, that's having an impact on the market. Ellen, go ahead and click to, okay. I wanted to talk about inflation because, we're seeing price levels even several months ago before it was evident that we were going into this spike in rents. And to some extent, it had us scratching our heads. We were anticipating the possibility of a strong recovery because of all the government stimulus. But we're looking at it saying, okay, is this market overpriced or not? And one of the factors I've been discussing with my clients is it depends on what all the stimulus does to the value of the dollar. I'm talking, of course, about inflation. And for the few of you out there who are old enough to remember the inflation of the 1970s, and you see it there on the chart, you understand at a gut level what goes on when the currency really isn't, the currency becomes somewhat unhinged. You're a little bit uncertain of what the currency is worth. I went back over 100 years here with this chart, 1914 through 1921, and you can see that the inflation of the 1970s wasn't an isolated episode. We had 3 episodes of high inflation in the 20th century. Now, the first 2 were tied to major wars, World War I and World War II. That was not the case in the 70s, although there was a lot of heavy government spending on the war and poverty, both social spending and then also spending on the Vietnam War. The Federal Reserve basically lost some control over the money supply. Now we're hearing from Washington that we're going to have a transitory period of elevated inflation, but it's going to be contained. Remember that subprime crisis that was going to be contained? So I'm not so sure. I'm not so sure if this is going to be contained or not. I saw the husband of my local residential real estate agent at the supermarket about a month ago. And I joked with him. I asked, so have you seen your wife lately, or have you pinned her photo to the back of the milk carton to drop a hint to her? And he laughed and he said, yeah, she's pretty darn busy. And he said, who knew? I guess all our properties are worth $500,000 more than we thought. And here he's referring to the homes. And I said, yeah, or the dollars are worth a lot less than we thought. And this big spike in home prices is really a sign of this onset of a major period of inflation. Now, when I look at houses, and I know this program is not about houses, but when I look at houses, I can sit there and I can see, okay, we've got a demographic boom, the millennials hitting the market. At the same time, we have record low interest rates, and we have San Diego's chronic supply constraints. So you can see forces other than inflation that can account for a lot of the jump in values. But nonetheless, I have concern. Ellen, if you can go to the next slide for us. Okay. This shows what happens if you have $100,000 in the bank in 2021 and you decide, well, this inflation is going to last 12, 18 months. I'm not going to get too worked up about it. This is what happens to your money in real inflation-adjusted terms over 5 years with only 5% inflation. Of course, it compounds. And so after 5 years, you're left with $77,000 in 2021 purchasing power. So, if we are getting into a period of inflation, leaving cash on the sidelines it's not a wise option. So we're facing a lot of uncertainty at this point. We don't know if the inflation is transitory or not, but if it's not, the prices we're seeing today that have us scratching our heads saying, are these prices high, are going to look like a real bargain in 2 or 3 years. Wraps it up for me. I'm sure there's going to be a lot of questions out there though, Curtis.
Yeah, I have a lot going through my head right now, and questions and statements. Just, to think it would be here today, and I think everyone in this audience here is talking about how robust and how kind of crazy the market is. And I know a year ago, I was having conversations with some of you, and I thought, I didn't know what the heck was going to happen. I thought it was going to make 2008 look like a boom. And it blows me away, and I'm happy to be wrong because I'm normally not, pessimistic. So it's very interesting that everyone just take on this. What do we think can stop this market? So if you're getting inflation, Robert, and you own real estate, what do you really got to be worried about? What should somebody be concerned about?
That's a really good question, because if we do end up with entrenched high inflation, the U.S. government's not going to be able to sell bonds at current interest rates. They're going to get forced into either raising rates or they're going to have to directly purchase those bonds themselves, which is monetization of the debt. And which just ends up into an upward spiral of inflation. And so, but then we start getting into a problem where, mortgage interest rates are rising. And so even if we have rents that are rising because of inflation, because tenants are getting inflationary wage increases, they're able to pay higher rents. So as tenants compete against each other for the short supply of apartments, rents will go up. You end up with an issue of, it's almost like a balance between, okay, rents are rising, but so are mortgage interest rates. And so then you've got to get your Excel spreadsheet out or your Argus runs out and start looking at, well, now what can we pay for these assets? The other real concern is we have a statewide rent control measure that caps rent increases at 5% above the CPI, but there's a ceiling on that. Regardless of what the CPI is, if the CPI hits or exceeds 5%, property owners are capped out at a 10% per year rent increase. Now, our operating expenses aren't capped out.
Right.
So we, and I don't see the inflation genie being so big that we get into a period where our operating expenses are rising faster than 10% a year, where we could potentially end up going into negative cash flow on our apartments because we can't, because of regulatory cap, we can't raise rents fast enough to keep up with operating expenses. But also, as you pointed out, Curtis, 12 months ago, we would not have foreseen ourselves to be in the position we're in today.
Yeah,
in the future.
Yeah, no, I mean, it blows me away. But I guess part of what you're talking about that I could see derailing things is, as you get inflation, everything gets more expensive. And we're kind of already seeing this with, the government mandating, certain wages to be increased. And you're seeing a lot of prices go up. And what's happening is I think the government as a response, and I think especially here in California, is trying to pass a lot of legislation that is very pro tenant. I mean, and they obviously always have, but it seems like, things get so out of hand. I can also see something happening where rent control gets even more strict, or even I can see owners who own properties. What used to happen is you'd have an owner who owns a property free and clear. They've owned it for 30 years. They have tenants in there. They don't bother them, and they don't bother the tenants, and they keep the rents low. And it's all fine and dandy, right? You gotta, I see this all the time where landlord would have a tenant in there for 20, 30 years, and they'll even sell a building and say, hey, I need you to keep the rent or something like this for this tenant. Well, for those owners, what the rent control has done is if you're way under market rent, you can't raise the rent to market until somebody leaves your unit. So, and you can't, you also have to have a justification to evict them right now. So now, is it going to cause landlords, I mean, as probably an intelligent landlord or as an advisor, you'd probably want to tell your clients they need to keep up with the rent increases every year, because if they don't do it, they can't catch up. So if they don't, let's just say over the next couple of years, you can raise your rents 5 to 10%, depending on the CPI and the limits. If you don't do that, you can't move your rents up. And then you get in this downward spiral because now your current tenants are going to have below market rent. So there's no way they're going to want to leave. And now you're going to get this cycle. So I could see if they have legislation that's stricter than it is, that could cause a problem. Or like you said, with inflation, with having the rent control, are people not going to take care of their buildings? Is there anyone here on the panel? I know there's been some kind of rent control on the business side of it. Can anyone kind of talk about that as far as what's going on with some of the tenants who weren't doing so well during COVID, and any kind of rent moratoriums with them?
You know
Yeah.
what, Curtis, I'm also going to jump in at this point and just remind everyone that we do have a Q&A available, and we do have a question up that I think is for Robert that kind of touches upon his comments on his last statements. Robert, do you think multifamily is due to hit a down cycle in the near 3 to 4 years?
Okay, good question. For the next 12 to 18 months, for the foreseeable future, it's looking like we're going to have a bull market. I personally tend to be a conservative person, and so I see 5 out of every 2 recessions coming. I was anticipating through the latter half of the team, 2016, 17, 18. I kept thinking, oh man, this thing's got to top out soon. At some point we're going to have a correction. And the bull market really continued through the end of 2019. Late 2019, we began to top out. It was still an active market. I would not have characterized it as a slow market, but it was losing momentum. But now with, rents beginning to surge, I don't see anything. I don't see any reason why it would turn around. When I say turn around, meaning correct. Whenever you ask 3 or 4 years out, there's just so much uncertainty out there that no one has binoculars that give them a good view that far out. So it's impossible to answer.
We'll just wait and see.
Yeah. Lisa, what, in the office sector right now, you were talking about, Andy probably versed in this also, is just, are a lot of office owners trying to, since biotech is so big, I've heard both of you kind of talk about people trying to convert space from office into different uses or specialized uses. What are you guys seeing out there with that?
Well, I'll start and maybe I can hand it off to Andy. Clearly there's been a pivot on some very large projects in San Diego, most notably the IQHQ campus, which is going to be, when it's done, about 1.5 million square feet of life science. That was the former Manchester Pacific Gateway project that was going to be office and mixed use hotel retail. So that's already happening. The campus at Horton, which was formerly Horton Plaza, also converted from what was going to be mixed use / tech to now life science, and with an increase in density up to 1 million square feet. And then the Thomas Jefferson School of Law building that traded as an office building 2 years ago to a Denver-based company is now being converted to life science. But those are very large institutional plays. I think for the smaller owner, the more regional or local owner, they don't have the capital to make a conversion, and they don't also have the ability to attract a scalable life science tenant. So their core decision is how they handle their office product, or do they look at a conversion perhaps to multifamily? I think by and large, the office market, owners are leaning in. They're still, most of them have put a lot of either reinvestment into their properties, or they've bought their property at a historic high, rate. So they're just trying to figure out a way to grab some occupancy while still keeping their face rates up. And that's probably the biggest disconnect right now between landlords and tenants across San Diego. Tenants sense, obviously there was a lot of softening just in the economy and in the overall real estate market here due to COVID. And now that, people are going back to work, landlords are more emboldened. They want, they're not backing off of their rents. They're providing some additional concessions, but quite frankly, you'd be surprised. I mean, downtown, a 36,000 square foot tech deal was done at Diamond View. Most of you probably have read about that deal, but I mean, it was at a high watermark rent for even Diamond View. I mean, it was I don't want to say the starting rate, but it was well north of $4 starting. And then, in Del Mar Heights, One Paseo is 100% leased.
Wow.
And reportedly, the last deal that they did was north of $6 starting. So, I mean, there's a lot of, very, I guess, bold and confident moves that some landlords are making. And that doesn't require conversion to life science. And don't forget, the tech market is very, very strong in San Diego as well. Along with the VC investment that was, at an all-time historic high for life science. Same thing happened last quarter for tech. I think we had $400 million in VC investment in tech. And the tech sector is very strong, really, really very strong in UTC right now. Apple just took another building with the Irvine company. They signed a lease last year, end of 2019, for the Kilroy project on Town Center that was going to be, either a life science or an MOB building. So, I mean, tech is just as much of a factor in San Diego in the office market as any other component of our economy. And to Robert's point about universities, I think a big driver for that is we have a university system that's improved dramatically and has become world-class over the last, 20 years. And believe it or not, San Diego is still very much considered affordable by people who are living in Northern California. So tech companies can really attract and retain some of the best talent when they open a secondary location in San Diego as opposed to Austin or Research Triangle Park or Boston.
Okay. Any comments from you, Andy, on this?
Yeah, and I fully agree. I mean, on the tech piece, it's interesting, like pre-COVID, the big fear that I know a lot of the life science users were running into is groups like Apple coming into the market and being able to take space down overnight. And who doesn't want to do a deal with them as a landlord, whether life science or not. Biomed did 200,000 feet in a build-a-suit with them really quickly. And they, subsequent to that, they've had right of first refusal on almost everything in that pocket in UTC.
Wow.
So you could get down the line on a which takes longer to do on the life science side. Then you have to put that 10 to 15 day waiting period while Apple decides on whether they're going to take their space from you. I've run into it 3 or 4 times. Once I got it under the radar, but most of the time you get blown out.
Wait, so Andy, what you're saying is Apple has first right of refusal for?
Yeah, but they have it on a number of spaces in UTC, and it's been an issue for other life science groups that can't move as fast, or and they take it on terms of a life science deal too, right? So who wouldn't want to take that over a life science group that could still have 50-60 billion dollar market cap, but you can't still beat out Apple, right?
That's amazing. So how does Apple, are they paying for this first right of refusal as a part of their lease deal, or how does that work with a company like Apple? Or
it's just strength and having
right.
Landlords that have large footprints, right? So
right, I guess yeah. I mean, who wouldn't want Apple as a tenant? That's I didn't realize that. That's interesting.
So you were running into that like pre-COVID. It kind of was a lull a little bit, like probably Q3 and 4 of last year when Apple kind of held back, and then they've come on like gangbusters in the market of chasing product and taking space down. So that's like something that's always kind of in the back of the mind. Never mind the fact that the life science market's extremely tight just in general.
Are you seeing any life science leases? Anything? Are you guys seeing anything downtown area?
Well, that's the thing. So I mean, I grew up in Massachusetts, right? So I watched Fan Pier be developed from an industrial area to Vertex taking 1 million feet. And now you cannot find space there, and it's a huge life science cluster in central, downtown Boston, right? So on the water. I've always wondered why San Diego downtown didn't have life science. I knew it's going to get there at some point. I'm still a big believer of it. People call me crazy, but so be it. There's activity on the space there. I think there's, Horton's got it, Island's got it. I think those are obviously the first two that'll go, mainly because they have the parking figured out, which is like a big component. They're also going to be delivering faster. I think Island site with phase 3, that delivers in like March, and it's going to be spec. It's proven ownership. That's the other piece with phase 3. You have to remember these life science companies, a lot of them, especially in San Diego, they've started and sold probably 3 or 4 companies, right? And they've usually been with BMR, ARE, phase 3, HealthPeak, and groups like that. So they trust in the delivery of the space because they have billions of dollars on the line with their company, right? So going to a proven group that also has scale, where it could be 50,000 feet, they raise a fund, next thing you know, they're 200,000 feet, they can tear up the lease and move them somewhere else in the portfolio, which ARE is like famous for. So yeah, that's a big factor as well. So
okay, interesting. Josh, what with the is there any oversupply anywhere? I mean, I think Lisa, you're talking about downtown. You thought there's a little oversupply of office space.
Yeah. Well, yeah, we're at, depending on who you believe. I mean, we're anywhere between a 10 and a 15-year high in office supply, with basically more coming online. I mean, a project just delivered in the B Street corridor. The LeBeau Realty Company developed a 100,000 square foot jewel box on the Bank of America site. Kilroy's finished 2100 Kettner in Little Italy. It's a beautiful project. They're reportedly holding out for a full building tenant if possible, but certainly more than half the building is what they're saying they want to lease to a single user. So I mean, we've got a lot of inventory and the demand is coming back, but certainly the post-COVID effect has hit office just as hard as it's hit retail. One interesting data point that the Irvine Company recently shared with me is that about downtown's outperforming the rest of their submarkets as far as return to work. So about 40% of their office tenants downtown have said that they've reopened, and professional services is kind of leading that charge. Whereas tech, which has been super strong throughout, performing throughout all of COVID, has been kind of the last to bring their tenants back to work. And part of that is they're a little more sensitive. They have a better, ability for their employees to work from home. So, but downtown's definitely kind of the loss leader right now in occupancy.
Well, what would you advise a client right now has office space downtown, excess office space? I mean, shared workspaces, we talked about that a little bit. I mean, you didn't think that it's a tough business. What would you advise somebody right now who has excess office space in downtown market? What do you tell your clients to do?
I would tell them to put it on the market for sublease. Right now, if you do a CoStar search for space between 1,000 and 2,500 square feet for sublease, there's literally just a couple of options, which is surprising. So that's a way to just band-aid a short-term kind of lag in backfilling your space. But I think the bigger question is why would you want to stay downtown as an office tenant? And I think there are a lot of amazing reasons why you would want to do that. And to Andy's point, what's happening on the life science front is going to have a trickle-down effect, just as it has historically in Torrey Pines and Sorrento and UTC. Life science companies need professional services support. And so if I were providing strategic advice to a client in that sector, I'd say it's coming, and you want to be the one down here to have the proximity to those types of users because they're going to use your services.
Do you think there's any, we talk about the shift of life science down to the waterfront around downtown, perhaps. Now, when you look at like census tract data and you look at where households are with STEM degrees, a lot of those are more in North County. Mm-hmm. Do we figure that people are going to be willingly going from that sort of UC San Diego area and commuting further downtown to get those jobs, or do we feel people are going to move down there? That's one of the things that I wonder about downtown, is because everybody's just comfortable being closer to where they're working, up where they're already living, and trying to attract employees down there. I wonder if that's going to be as easy.
Well, I think a point with that, Josh, is part, I'm in Carmel Valley and we've gone crazy. I think a lot of it has to do with schools. I mean, for example, downtown would be an incredible place to live. And I know they're trying to do the live work thing. A lot of people are down there, but I think education and where you're, being close to where you work. And then just school districts, I think, has a big play with where people want to, put their offices or work. I don't know, did I hear a rumor, or has it already happened? Is Apple taking a big space up here off the 56 corridor, or do we know of any big leases up here? You know of anything?
I know they've been taking space up in Rancho Bernardo.
Okay.
That seems
The 56, yeah, there's a tenant in tow for the product on the 56, but it's not Apple.
Okay.
Well, I guess, Josh, you and I were talking about regional transportation and Sandag's regional transportation plan, a couple of days ago. And what I would say is, with our regional commuting changing significantly in the next couple of years, just with the onboarding of the trolley extension, and you see that UCSD's made an investment in a footprint downtown, I think that you will see people commuting and reverse commuting. We also have a workforce on the life science and tech side that's going to be, younger, and they don't necessarily care about being in the suburbs with, good public schools at this point. They want to be where the action is. And so I think, even though we've talked about the live, work, play for so many years in downtown San Diego, I do think that now we have kind of the levers for that to really come to fruition. So
I think, I was going to say, Lisa, to that point, I mean, like, we're seeing a lot of companies come in from other markets like Boston. I mean, even I have a group that moved an operation out of New York City, Life Science Group, right? That are coming into San Diego, and even from San Francisco, just because they look at the market as having more availability than the zero availability in Boston and San Francisco, and the cost of living is lower. But the thing you have to realize when these people move here, like one of the CEOs, lived in the Flatiron District, and he's like, I don't want to live in Carmel Valley. No offense to Carmel Valley, but he's like, I've walked to work for like 10 years, I want to live in downtown.
Well, here's a question with that. Somebody posed a question here. As far as the homeless problem, we've talked about this amongst us. I think, is a homeless problem downtown going to present issues to the tenants and people moving down there? Because it's just getting worse and worse. So how is that going to affect people wanting to, move their offices down there or live down there? Is that, does anyone see that as being a problem?
Oh, I'll take that one. Yes, it's affecting, it is affecting our ability and our economic drive as a region right now. And our political leadership needs to get more serious about figuring out solutions and not just throwing, kind of onesies and twosies at this. As a state, California is having huge issues. Anybody who's been to LA recently or San Francisco, we'll see that. But in downtown San Diego, we are going to collectively as a business community have to put pressure on our elected officials, because that's where it's going to truly start to move the needle. And I don't know that at this point, a business won't come downtown because of homelessness, but I will tell you this, landlords downtown right now are day-to-day experiencing loss of very high quality companies in their portfolios, because companies don't necessarily feel like their employees are safe. And this isn't any sort of social commentary on my part. It's just a fact. It is just a fact. It's a very serious issue. And by the way, it's trickling into all parts of San Diego County. It's not just a downtown problem or an East Village problem or it is, we're all experiencing it.
Yeah.
Everywhere.
Yeah, no, it'll be, I don't know how they're going to solve the problem. So that I think that is a real issue, and especially if you're going to be downtown in these areas.
Well, they have to stop the influx. That's first. You can't suture a wound if you don't stop the bleeding.
Right, and then and who's willing to make the tough decisions to make that happen? I think that's really
we didn't have the same issues 10 years ago, and we've always had great weather. So it's a municipal, we need some action on the part of our municipal officials. We just do.
Yeah. Well, and I think a lot of people will say, their rebuttal to that was it's a housing prices.
No.
San Diego, though, we're one of the most difficult areas to build. Robert, what are you seeing? If they're saying housing is one of the reasons for the homelessness, obviously it's also mental and things like that. Well, they're not helping it by making it so difficult to build. I mean, it's taken years and years and years to get projects approved, plus a permitting cost are a fortune. Right, Robert?
Yeah, so we're going to put up about 5,200 apartments this year. And, you know, in terms of, I think one of the questions that came in prior to the past week leading up to the meeting, someone asked, is there a potential for us getting into an oversupply problem? So we're going to produce 5,200 units. 19, I'm probably going to get the dates wrong. 87 and 88, in that 2-year period, we permitted 52,000 multifamily units in San Diego County. Now, that led to an oversupply, okay? 2 years, 26,000 a year. 5,200 will be absorbed. We have eliminated or reduced the amount of naturally affordable housing, because when you have a shortage, right, a lot of the older apartments, when you can't build new and you have tenants who want newer, nicer apartments, it's opened the door for the Class B owners to renovate their properties and turn them into Class A's, and the Class C's get elevated up to Class B. So it leaves you a shortage at the bottom of these Class C units. But I think a lot of what I'm going to call homeless advocates have done a disservice to their constituents by calling it a homeless problem. So now I'm going to contradict myself a little bit. When the majority of the people on the street are having problems with addiction and with mental illness, it's not about the housing. They're not going to be able to pay enough rent for a property owner to maintain an apartment, let alone generate a profit off of an apartment.
Well, and also their answer for fixing it is what they, you know, their marketing name of affordable housing, which is not affordable at all. You know, it's subsidies to builders, and they end up, you know, I see units that are being built that are $500,000, $600,000 per unit, where you could go out, if you want to solve the housing price, you could go buy Class C buildings and then for less money and house more people. So that's, yeah.
We've got to have an honest conversation about, you know, defining what the problem is. There is a percentage of our society that either don't have the skill set, they don't have the mental health, or they have addiction problems that keep them from being able to live and independently support themselves. And as Lisa said, you know, we need some kind of solution for that. But to label it strictly as a housing problem confuses the matter, and I don't think it needs to.
Yeah, I agree. I agree, Robert. But I'm just telling you, as far as what the people justifying the homelessness, you know, they're saying it is a housing problem. They're putting it back on the landlords, and it justifies the rent control, and this is their backup for having rent control and things like that. So I'm sorry, Lisa.
Well, Robert, all really good comments, and I agree with you wholeheartedly. And I think, you know, another part of the issue is that as San Diegans, we want to take care of our own, but what we're experiencing as a region is other municipalities and it just, you know, even Newport Beach, for example. I mean, we are inheriting other cities' issues. So instead of them trying to solve their problems, they're shifting them to San Diego. And that's a part of the conversation you never hear talked about in a public forum by our elected officials. So
basically because we're not as tough and homeless as these other cities. So
exactly.
Just by right of that, people are going to come here.
Exactly.
With that. Okay. Yeah. So, I mean, homeless is going to be a huge issue with all of these things, but it seems like the companies seem to be making up for a lot of those things. We talk about, like, what is, you know, pandemic. It's definitely not behind us. Now we have this whole Delta variant and things like that. Is anyone worried about, how worried are you guys about things like this, the whole thing, you know, acting up again? What's everyone's level of call it fear with maybe having another second round of pandemic, like, you know, like they did in the Spanish flu? The second round was worse than the first. Anyone want to touch on that?
Well, I mean, look at Japan. I mean, you'd be crazy not to be a little concerned about that. I mean, look at what's happening with the Olympics because of the resurgence of COVID in Japan, which is, was very aggressive at the beginning of the pandemic and addressing it. So I think, yeah, it's a concern, and hopefully, we don't end up like Australia or Japan with another, shutdown.
Yeah, because that would be huge with everything. Some other question. We're talking about large commercial spaces, but a lot of people are, what about traditional office spaces around the region like Kearney Mesa or some of the smaller markets? And what's going on with those markets?
Very just on a smaller scale, they're just trying to navigate the back to work and accommodate workforce. I mean, Mission Valley's been performing really well. And Kearney Mesa, because Kearney Mesa is a diverse market, it's not just purely office. There's a lot of flex opportunities. I think they're both coming back, but second quarter positive. My prediction is third and fourth quarter much more positive in those particular suburban markets.
Okay, all right. And I have another question here that I'm curious about that could have a big effect on the sales market is, they're talking about things like taking capital gains up to 49% or something, 23, or like 43%. Anyway, a lot. So basically in California, you'd be taxed at close to 60%. And then things like getting rid of the 1031 exchanges. I mean, that definitely I would feel derail the market, or at least definitely stop transactions. I mean, what's everyone's input on the 1031 and capital gains? Does anyone, you think it's gonna happen? I think taxes are gonna go up, right? So how is that gonna affect the market? Is that gonna mess things up?
Probably depends on the property type.
Yeah. I guess if you're a huge institutional investor, it's probably not quite the same. Well, I mean, it trickles down depending on who you ask. But I mean, if you get rid of the 1031 exchange, is that going to cause more or less sales? Less sales at first, and later on more sales because people. Yeah, I don't know. What do you think, Robert?
In the multifamily space, if 1031 were to go away, we could. I think we would easily see a drop of 1/3 of our volume, and potentially 50%. If that were to be coupled with, Biden's plan to increase capital gains tax, I think we'd be looking at greater than a 50% drop in transactions. Now, I don't think that all of that's going to come to pass. My hunch is 1031 will survive. It's been under attack. I mean, I can remember back in, I think 1990, when I first got involved in politics, it was going and having lunch with Bill Lowry, my local congressman's rep, to discuss 1031, explain what it was to him and the importance of it. So this has been going on for 30 plus years. And the fact that it causes a lock-in effect, I think it'll survive. I do think we are going to see higher tax rates, and
well, if you look at sorry, Robert, if you look at higher tax rates, for example, I looked at your inflation data as far as if you have money today, what it's worth in 5 years from now. Well, talking about instant inflation, if they raise the taxes, that also is instant, deflation on your dollar. So in some ways, someone may look at this, and I think it's definitely probable our taxes are going to go up, right? I mean, this is kind of what happens through administration to administration. If somebody feels like it's going to go up to what they're proposing, well, then it may make sense to sell right now, even with inflation, because what you have left right now is quite a bit more. And so even after inflation, so that'll be interesting, I think, conversation to have with clients and builders. And that's where I think IREM and CCIM people are going to come in to help advise people on trying to figure out these answers, because there is no obviously black and white answer with a lot of this stuff. There's a lot of what if scenarios and a lot of assumptions. With that, here's a question I'd like to ask to everyone right now. If you guys had, $1 million to place right now to do something with it, again, you can put it in the bank, you can invest in stock, you can bury it under your mattress, you can buy more property. Let's start with Robert. What would you do with that $1 million right now?
Okay. One of the mistakes I've made in the past, and I try to avoid repeating is don't let my politics affect my investing. Make good investment decisions. And so, we can look at what's going on in the regulatory environment and paint a picture of doom and gloom. But then if that stops me from participating in this future that Andy's talking about, that Lisa's talking about, the growth in the biotech sector in San Diego. San Diego's got a rosy future. And I should be continuing to participate, providing housing out there. So some of that would go into well-located apartments in San Diego, acquiring properties with good bones. They might be in original condition, but I can go in and turn those into, the interiors into beautiful 2021 apartments. So that's what I would do.
So you'd probably be going into places, maybe reposition some of the asset types, find something at a market value, but something that can be turned around and increase rents and keep it in multifamily. Okay. Is that kind of
right?
Okay.
And it might take me a while to work those rents up because of the restrictions in place, and I'll just have to play ball with regulations that are in place.
What about you, Josh?
I'd go residential, whether it's single family or multifamily. I think those,
Okay.
those
All right,
two.
San Diego?
Yeah.
Not out of the area. Okay. Lisa?
Multifamily, I did it recently. I sold a house in Deer Valley at the end of 2019 and exchanged into 10 units in Golden Hill, and wish I had more deals like that to make. So if anybody wants to loan me and my husband $1 million.
Right, well, so far it's in the residential multifamily. What about you, Andy?
I think when you asked me the other day, I would say put it into like a life science related REIT, but I don't know. I'm sold on multifamily. Robert, you got me. I'm in a couple funds on it, but I would like to do more. I think
Andy, I'll call you. Let's
do it.
I'll call you.
Yeah.
Put the band back together, Lisa.
Yeah.
Okay, so so it's interesting. So we have the multifamily over there. What about, okay, let me try to do another question here. As far as each of you have a specialty, kind of, Lisa, where were the opportunities? Like if you had somebody like a tenant or something, where would you recommend them? What are the opportunities for them? I know part of it's based on their needs and wants, but sometimes there's a little bit of work around there. Where are like opportunities for somebody, wanting to get space in this market?
Well, as it pertains to office space, a lot of companies are really thinking long and hard about employee retention and recruiting. And so I wouldn't so much give locational advice as much as I would give environment advice. And right now, what employers are saying that's important to employees, both as they keep them and as they try to hire them, is what does their physical workspace look like? How can they change it up? Even small offices can do things to make it a lot more attractive for their employees. And so I talk about that a lot with my tenant rep clients and also with my landlord clients, because to the extent that a landlord can create some engaging spec space or communal space or outdoor space, it's more important than ever. And the same for employers. And so, Gensler did a survey recently of, I think 100 decision makers, and what was their focus as they brought their employees back to the workplace. And almost to a CEO, the response was health and wellness, high engagement, collaborative space, and just the opportunity for people to re-engage with one another and meet, whether that's a high-end coffee area or an outdoor balcony space. So I think that's the advice that I'm trying to give my clients and have them really think about that, because that's where they're going to drive their revenue, is having those right people come and work for them. Okay,
great. Well, thank you. What about you? I mean, what about you, Andy? What would you, is there any advice you'd able to give to somebody? Market?
I think a lot of it's along the same ways with what Lisa said. I mean, amenitized space. I mean, that's everyone's 100% focused on that in the life science industry. These people live at their jobs, so that's just extremely important. They want it. They want collaboration space, outdoor conference rooms, stuff like that.
Okay, and collaboration space is still
Yeah.
real big, huh? Okay.
Very much.
Robert, where do you see, like, what do you advise your clients where the opportunities right now in your niche?
You know, we're going after location. You know, I like the metro area, but that's just what I know best. And we have seen a lot of acceleration there. The other thing I like is some of the outlying cities, whether in North County, South County, the old metro areas around those cities where people can get into a walkable environment. I'm big on that, and they may actually have more runway for appreciation in those markets than the metro area, because the metro area has been puffed up pretty high over the last half dozen years. It's so heavily canvassed that, you know, might be where we're at the balance point where there's more opportunity in some of these outlying markets that have had a little bit less attention.
Okay, no, that's great. And Josh, is it multi, you know, again, would it be multifamily residential too? That's what it sounds like, correct?
Yeah, I kind of want to reiterate Robert's point. You look to North County cities like Oceanside or Vista, or out in La Mesa and El Cajon, or down in Chula Vista in South County. Those areas look, from a multifamily perspective, pretty primed. There's been huge demand in those areas over the past year. Occupancies are like 98, 99% in these cities, which is sort of insanely high. And this is where a lot of people just want to live. You know, obviously there's a flight to downtown and whatnot, because of everything that downtown has to offer, which is unique to the city. But those areas, people want suburbs too. And I think there's probably going to be a psychological shift too, that we're probably not sure how it's going to affect us in the coming quarters or years, just from the past year under COVID, and what that's going to do to how we perceive our living space and how we want to go about our daily lives. If we want to be in a tight-knit, dense area, or we want to have a little bit more room to spread out with a little bit more green space.
Yeah.
I think that's sort of one of the great unknowns, how we can weigh all the commercial factors, but I think the psychological factor is also sort of at play, and we don't really know how that's going to impact sort of everything.
Well, if anything's taught us this last year, psychological factor has a lot to do with everything. And I'm just glad, you know, I think I speak for everyone, that we're in a panel right now where everyone is pretty darn optimistic. And Andy, I'm sure the panel you were on last year, you probably weren't quite as, you know, everyone probably wasn't quite as, the expectation probably isn't what it is right now.
It was a long year, like internally, externally, like having conversations, because you hear people talking about the office market or retail or whatever, and then they'd ask you about life science, and you just kind of like, it's okay, you know,
Right.
because you don't want to, you know. But I'm glad like office is coming back, retail, everything. So, I mean, it just helps everything.
Yeah, no, I think it's great. I think it's made everyone think about things a lot differently. I know it has gotten me to think about things, and I'm just happy things are doing well, but it's definitely, you know, I think we're all in different stages in our lives. I know it's gotten me thinking this last year into a lot of things, and I feel like we got lucky. You know, it could have been just absolutely horrible. And it obviously was horrible, the pandemic, but as far as like with the economy and what's going on. So I just want to appreciate, you know, I just want to thank everyone who's here today. Thank you so much. We're going to send you a little token of appreciation. And as far as our audience members, I try to get as many questions as I could, and some of them that we couldn't get to, I'll see if I can get those answered. We can get those back to you. If you, as an audience member, if you have maybe a polling question or something that you think would be interesting that we should send out after this for some people to answer, you know, maybe answer some of these questions we had today, let us know so we can do that. And then, you know, stay tuned for kind of this will be recorded, and, you know, I may try to get some of this transcribed into notes and recap it all. Do you have something else to say, Robert?
If I could jump in, we have discussed multifamily quite a bit, but, you know, really it's such a subject and we've just glazed over the surface. But for those who are interested, San Diego CCIM chapter and the Apartment Association, the Southern California Rental Housing Association, have a joint program. We've been holding every year. This will be the 31st annual apartment perspective will be on October 14th of this year. And as of right now, we are planning to meet in person. So
Nice.
if you're interested in learning more about San Diego County multifamily, October 14th, the apartment perspective. I'll be looking forward to seeing you.
I'll definitely be there. It's a signature event. It's always good to see you there. And again, pay attention to CCIM and IREM websites, you know, our CCIM San Diego for our local events coming up. We're going to be doing a lot more things live. I'm sure both organizations would love to have suggestions on what they'd like to see from our members. So again, I appreciate everything. I think I turn this over to, is it Kim right now, or when do we do this raffle?
Thank you, Curtis, and thanks to all our sponsors, speakers, and of course, for all the behind the scenes work, Ellen with CCIM and Nicole and Julie with IREM. We really appreciate everything that you guys do. So for those who are still with us, we have our raffle prizes to give away. They were drawn earlier, so we'll just get right into it. We have a $50 Amazon gift card donated by Gary Griffin with Blue Sky Restoration Contractors. And that winner is Tom Sellers with A&P Management, AMO. I swear I didn't pull these guys, okay? We have 2 premium member seat tickets to the Padres versus Miami on August 11th at 1:10, donated by Andy Biondolillo with the Forestry Group. And that winner is Robin Hathaway. Robin, I am available that day if you need a partner to go with you. Next up, we have an Aperol Spritz making kit donated by Erica Mann with Countywide Mechanical Systems. The winner is Yolanda Derricker with Pacific Coast Commercial, AMO. And we have 2 $25 Chipotle gift cards donated by Eric Monroe with Keith Monroe Painting. The first winner is Natasha Tucker with Casa Vida, AMO. And the second winner is Mark Egan, CPM with Health Peak. And last but not least, we have a $50 Starbucks gift card donated by Debbie Palumbo with Sherwin-Williams. And that winner is Rachel Martini with Cushman Wakefield, AMO. And that's all we have, everybody.
All right. Thanks so much. Have a good day.
Thank you.
Bye, everyone. Thanks, Curtis. That was a great